Welcome back to Crypto Regency, where we cut through the noise and give you the institutional-grade analysis that actually moves markets. If you're serious about crypto, you're in the right place. Make sure you're subscribed so you never miss a breakdown. What actually moves an asset's price? Not tweets, not influencers, not Reddit threads. Real price movement comes from one thing: capital, specifically where large pools of capital are permitted to flow and what infrastructure exists to receive them. Today, we're going to break down the structural case for XRP, not from a speculative angle, but from a capital markets perspective. We're going to look at macro liquidity cycles, institutional infrastructure build-out, regulatory developments, and the emerging tokenization landscape. And we're going to explain precisely why these forces, when they converge, don't produce gradual price appreciation. They produce repricing events. Let's get into it. Part 1. The macro backdrop. Liquidity is everything. To understand where XRP goes, you first need to understand the environment that controls all risk assets. Over the past 2 years, global liquidity contracted sharply. Central banks raised interest rates aggressively to combat inflation. The US dollar strengthened, credit conditions tightened, and risk assets, equities, crypto, emerging market debt, all compressed under that pressure. This is not a crypto-specific story. Crypto is a high-beta liquidity asset class. When liquidity tightens, capital retreats from risk. When liquidity expands, capital flows back in, and it flows into higher beta assets with greater force. Here's what matters right now. We are in the late stages of that tightening cycle. Bond markets are already signaling a shift. Yield curves are normalizing. Inflation expectations are moderating. Meanwhile, fiscal deficits remain large, and debt servicing costs are rising globally. Governments don't sustain that environment indefinitely. Policy eventually adapts. When the liquidity cycle turns, and it will turn, capital doesn't re-enter markets gradually. It floods, and assets with improving fundamentals and reduced regulatory uncertainty absorb that capital disproportionately. XRP is positioning itself to be exactly that kind of asset. Here's why. Part 2. The velocity argument and why it's incomplete. One of the most persistent criticisms of XRP as a price appreciation asset is what's called the velocity argument. The theory goes like this. XRP is designed as a bridge asset for payments. It moves quickly between counterparties. Because it doesn't need to be held, there's no accumulation, no scarcity, and therefore no meaningful price increase. The token is always in motion, never stored. It sounds logical. It is also incomplete. Let's look at Bitcoin as a reference point. Bitcoin has no intrinsic yield. It doesn't represent future cash flows. It's not used for daily commerce at meaningful scale, and yet it went from pennies to over $100,000. Why? Because large holders began treating it as a store of value. Holding periods extended. Supply was removed from active circulation. As demand increased against tightening supply, price appreciated dramatically. Now apply that logic to XRP under institutional conditions. When large institutions settle high-value transfers, they don't want to move millions of tokens per transaction. They want fewer units representing higher value per unit. A higher XRP price means better liquidity density, less slippage, fewer corridor imbalances, more efficient capital deployment. This has been addressed directly by Ripple's technical leadership. Price appreciation in XRP is not just speculative, it's functionally useful for institutional settlement at scale. Add to this the fact that market makers, liquidity providers, prime brokers, and treasury desks will all need to hold XRP reserves as settlement volumes increase. That holding demand, even if it's operationally motivated rather than speculative, reduces circulating supply and supports price. The velocity critique assumes static market conditions. Institutional adoption changes the structure of demand entirely. Part 3. Infrastructure build-out. Ripple is playing a long game. Let's talk about what Ripple has actually been building, because this is where the real story is. Since 2023, Ripple has deployed roughly $2.7 billion acquiring financial infrastructure companies. These aren't speculative bets. They're deliberate strategic acquisitions of financial plumbing, Metaco brought institutional-grade custody, the kind that banks require before they'll hold any digital asset on their balance sheets. Hidden Road, now operating as Ripple Prime, adds prime brokerage and credit intermediation. Standard custody and related acquisitions bring regulated trust and treasury services. Put these together, and you have a vertically integrated digital asset financial institution, custody, brokerage, liquidity, and settlement under one roof. Why does this matter? Because institutions don't fragment their service relationships unnecessarily. They want consolidated infrastructure with clear compliance pathways. They want one counterparty they can onboard properly, not 10 different providers. Ripple is building toward being that counterparty. And as tokenization of real-world assets accelerates, more on that shortly, the institutions that have built compliant, full-stack infrastructure will be the ones that capture institutional flow. Ripple is positioning early. Part 4. RLUSD and the collateral integration story. Let's talk about RLUSD because its recent development trajectory is more significant than most people realize. Binance listed RLUSD on the XRP ledger for spot pairs and approved it as eligible collateral. That might read as a routine exchange listing. It isn't. Here's the market structure implication. When a regulated high-quality stablecoin becomes eligible margin on a major derivatives venue, balance sheet efficiency improves. Institutions can deploy collateral across derivative positions without converting to less efficient instruments. Fragmentation decreases. Capital velocity increases. Derivative markets are where institutional capital actually lives. Spot markets are relatively small by comparison. When stablecoin collateral integrates into derivative infrastructure, it becomes foundational, not just a trading pair, but a core component of how capital moves through the system. RLUSD being built on the XRP ledger and gaining traction as institutional collateral creates a direct link between settlement infrastructure and capital markets activity. That's a meaningful development. Part 5. Tokenization, the market transformation. Nobody is fully pricing. This is arguably the most important section because tokenization is not a crypto narrative, it's a financial market transformation narrative. Tokenized treasuries are already live. On-chain money market funds are operational. Major asset managers are piloting tokenized equity and credit structures. The infrastructure for moving real-world financial assets on-chain exists and is scaling. Why does this matter for XRP? Because when trillions of dollars in bonds, equities, derivatives, and credit instruments move on-chain, they require neutral settlement infrastructure. They require assets that can bridge value across chains, across jurisdictions, and across asset classes with speed and reliability. The XRP ledger is positioned directly within that evolution. It was built specifically for high-speed, low-cost cross-border value transfer. That's not a retrofitted use case. It's the original design intent. Now consider the numbers. Global bond markets alone represent over $100 trillion. Equity markets add another $100 trillion plus. Derivatives, notional exposure is multiples of that. Even a fraction of that moving through on-chain settlement infrastructure represents demand that current crypto markets haven't begun to price. XRP doesn't need to absorb all of that value. It needs to facilitate its transfer. And as transfer volumes scale, the liquidity depth required to support them scales with it. That's the structural demand story. Part 6. Regulatory clarity, the unlock that changes everything. Regulatory uncertainty has been the single largest suppressor of institutional capital allocation to digital assets, not technology risk, not market risk, legal and compliance risk. Institutions don't allocate to assets where the regulatory classification is undefined. They can't model compliance exposure. They can't satisfy internal risk committees. They can't get legal sign-off, so they wait. That environment is changing and faster than most people expected. Stablecoin legislation is moving through Washington with more momentum than at any prior point. The White House Digital Asset Council is actively engaged on questions of yield structures, broker-dealer permissions, and settlement frameworks. There are political tensions and competing interests. That's normal in any legislative process, but the direction is clearly forward. For Ripple specifically, years of legal uncertainty are giving way to partial and potentially full clarity. Legal resolution removes the single biggest overhang on institutional allocation decisions. When compliance teams can model the regulatory environment, capital follows. This is not a soft catalyst. Regulatory clarity is a hard unlock. When banks are explicitly permitted to hold and deploy stablecoins, when digital asset custody is clearly defined, when settlement finality has legal standing, capital allocates, not gradually, aggressively. Markets price certainty. When certainty arrives, revaluations happen quickly. Part 7. The Convergence. When three forces align. Let's bring this together. For XRP to reprice significantly, three forces need to converge. First, macro liquidity expansion. The global liquidity cycle turns. The Federal Reserve moves toward easing through rate cuts, balance sheet adjustment, or liquidity facilities. Capital rotates back into risk assets. Bitcoin leads, as it typically does in liquidity-driven rallies. Ethereum follows. Then capital rotates into high-beta assets with strong fundamental narratives. XRP, with improving infrastructure and regulatory clarity, becomes a natural destination. Second, institutional rails activation. The infrastructure Ripple has built, custody, prime brokerage, treasury services, stablecoin integration, moves from build-out phase to active deployment. Institutions begin onboarding, settlement flows increase, liquidity depth builds. The reflexive loop begins. Higher price improves liquidity density, which attracts larger flows, which requires deeper pools, which supports higher prices. Third, regulatory clarity solidification. Legislative frameworks are finalized. Compliance pathways are clear. Capital that has been waiting on the sidelines, pension funds, sovereign wealth funds, asset managers, global banks, can now allocate with legal confidence. When these three forces converge, price doesn't move incrementally. It reprices. We've seen this pattern before. Bitcoin ETF approval compressed years of anticipation into weeks of inflows. Structural catalysts don't produce gradual appreciation. They produce step-change revaluations. Are we there yet? No. But the pieces are assembling simultaneously for the first time. Part 8. Short-term volatility versus long-term structure. A word on near-term market conditions, because context matters. In the short term, XRP remains correlated with broader crypto market dynamics, macro volatility, trade tensions, equity pullbacks, dollar fluctuations, creates noise. Risk assets are sensitive to policy rhetoric. Corrections happen within structural uptrends. That's normal. Don't confuse short-term price action with long-term structural development. Infrastructure builds on years and decades. Liquidity cycles operate on quarters and years. Price often lags infrastructure, sometimes significantly, and then catches up violently when conditions align. The indicators that matter are not daily price charts. They are legislative progress on stablecoin frameworks, institutional custody adoption rates, tokenized asset volume growth, and Federal Reserve policy trajectory. These are the variables that drive the structural thesis. Watch those, not the noise. Here's the core insight to take away from everything we've covered today. XRP's path to significantly higher prices is not dependent on retail enthusiasm or social media cycles. It depends on a specific set of conditions: macro liquidity returning to risk assets, institutional infrastructure activating, regulatory clarity removing compliance barriers, and tokenized asset markets scaling. All four of those conditions are developing simultaneously. None of them are fully realized yet, but the convergence is closer than it has been at any prior point. Markets are impatient, infrastructure is patient, and when a liquidity expansion meets infrastructure that's ready to receive it, repricing becomes not a question of if, but when. If you found this analysis useful, make sure you're subscribed. We cover crypto from a capital markets perspective. No hype, no noise, just structure. See you in the next one.